According to the OOIDA Foundation, a new cycle in the freight market is still a long way off. OOIDA Foundation's market outlook has been negative since February, and this remained unchanged in the August report. High operating costs, low rates, excess capacity, and low volume/demand are factored into the current outlook. A breakdown of specific markets is provided below. Dry vans market. Increases in load-to-track ratios were reported, but the typical seasonal peak appeared to be less pronounced. Freight volumes were 24% lower than last year, but 4% higher than 2019 levels. The number of deployed equipment remained high. Spot rates typically rise around this time of year, and that's exactly what happened in August. In the future, most likely, rates will remain at the same level or decrease slightly due to rising diesel prices. The inventory-to-sales ratio has declined as monthly sales have increased. This is a positive indicator for truck demand, but the market will take longer to recover. Furniture inventory levels are declining, but appliance levels remain largely unchanged. The housing market continues to exceed expectations. Flatbeds market. The number of loads placed was about half that of 2019, and the load-to-truck ratio was down 57% from last year. The ratio is now 81% below the 5-year average. Spot rates fell for the 5th month in a row. Contract rates fell for the 8th time in 9 months. Rates tend to be lower this time of year, but it depends on hurricane season. Overall construction costs have increased, as have non-residential construction costs. The increased costs are likely due to inflation as demand for flatbeds continues to fall. Spending on highways decreased compared to the previous month. Considering interest rates and inflation, the housing sector is performing well. Sales of building materials, garden equipment and supplies increased, exceeding the 5-year average by $4.16 billion. The current trend will need to continue for several months to have an impact on the market. Market reefers. Agricultural output is picking up after a late start this year. The fall harvest season, which typically impacts trucking in late October, is just weeks away. Spot rates have risen, but so have contract rates, indicating that the trend is unlikely to continue. Freight volumes on reefers typically increase at the start of the fall agricultural production season. Fruit and vegetable rates are 27% below January 2022 highs. Carriers in the New York region saw the largest increases in per-mile charges compared to the previous month, while the Mexico-Arizona region saw the largest declines, according to the USDA. The number of trucks available has increased again outside of the Indiana region. Freight market. The Transport Services Index and Industrial Production Index rose. According to the Cass Shipment Index, new truck orders need to slow so that capacity in the for-hire trucking sector can shrink. The total number of people employed in trucking decreased by almost 37%. The closure of Yellow contributed greatly to this number. This figure is still higher than last year, but remains unchanged from the 5-year average. Both sales and orders for new Class 8 trucks increased in August. Used truck sales also increased, outpacing new truck sales by 90%. Overcapacity in the past few months has led to lower freight rates. Although sales of used trucks exceed sales of new trucks, the problem of excess capacity is still far from being resolved. August saw the fastest growth rate since February, according to the Logistics Managers Index. The Producer Price Index shows that spot rates are stuck at rock bottom. As a result, it is more likely that a new freight cycle will not begin until 2024. A 43-cent rise in diesel prices in August capped 8 straight months of price declines. The average diesel price is still lower than last year, but higher than the 5-year average. Wages are outpacing inflation and people continue to buy goods. Durable and non-durable goods became more expensive in July. Imports are down from last year, but are in line with pre-pandemic levels. The Journal of Commerce reports that prices for intermodal rail freight are 30% lower than truck freight.